All right, getting a little bit of a rally in futures. 30 minutes until the start of the cash trade. I'm Matt Miller.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, another CPI surprise. U.S. inflation data comes in below expectations, quelling concerns over price pressures. And concepts of a plan. The U.S. and China wrap 2 days of high-stakes trade talks with a preliminary agreement that really lacks detail. We'll try and suss that out. A Wall Street legend joins us to react. We'll get insight from one of the greatest traders of all time. Paul Tudor Jones joins Open Interest for an exclusive interview. Katie?
But first, let's take a look at how the trade is shaping up before the bell. You can see we have a rally on our hands when it comes to the S&P 500 in the pre-market, now higher by about 0.25%. That doesn't sound like much, and it's not, but we were really wiggling around pre-market, and it was CPI that boosted us firmly into the green when it comes to that bond market rally. 10-year Treasury yields currently lower by about 4 basis points, a bigger reaction in the bond market than you're seeing in stocks. And you can see the VIX volatility draining right now. That VIX trading with a 16 handle, Matt.
Wow, that's Liberation Day levels. The inflation print coming in softer than expected is really the main headline. Let's break down the data with Michael McKee. He's Bloomberg's international economics and policy correspondent. Mike?
Well, basically, Matt, we got half of what was expected in terms of the month-over-month increases. We did get a jump in the headline number on a year-over-year basis to 2.4%, but the core stayed at 2.8%, which was not expected. The big reason is because goods prices did not rise as much as people anticipated. They were flat on the month, while services prices rose only 0.2%. One reason for that is because gasoline prices fell by 2.6%. But a number of things that people thought would be contributing to higher prices for goods because of tariffs did not actually do that. Apparel prices down 0.4%. New cars and used cars both down 0.5%. And airline fares down 2.7%. Housing, the big reason that we saw any kind of inflation, up 0.3% as usual, the owner's equivalent rent.
All right, great roundup. That is Bloomberg's Michael McKee. One of the top stories this morning. The other top story is the White House celebrating a string of trade wins. The U.S. and China have established a framework for implementing the Geneva Trade Agreement, but it still needs approval from President Trump and President Xi. Also, we learned last night that a federal appeals court has allowed Trump to continue enforcing his global tariffs through July. Let's break it down with Bloomberg Washington correspondent Tyler Kendall. And Tyler, bring us to that trade framework that we seem to have established with China. What do we know so far?
Yeah, hey, Katie. Well, we heard from President Trump earlier today saying that the deal is done subject to final approval from himself and Chinese President Xi Jinping. We know at the heart of this was really trying to get at those export controls, those recent restrictions that both countries have put on products that each other needs. Now, we're still waiting on details here, but negotiators did suggest that it does appear that China would be willing to speed up those export licenses when it comes to critical and rare earth minerals that are so essential to U.S. supply chains. And in exchange, Commerce Secretary Howard Lutnick suggested that the U.S. would lift or loosen export controls put into place in recent weeks. Our reporting suggests perhaps this could extend to the design software for chips, also jet engines, but we're going to have to wait and see. President Trump also said in a post on Truth Social that ultimately Chinese student visas might not end up being revoked as currently planned under the administration.
All right, Tyler, thanks very much. Bloomberg's Tyler Kendall giving us some of the detail that we have on that agreement. We're going to continue to suss more out of that for you and bring you that news as it's clearly market moving. We're seeing the Dow Jones Industrial Average, S&P 500, and NASDAQ futures all up ahead of the open. Now, we welcome our TV and radio audiences for a conversation with one of the most respected traders on Wall Street. Paul Tudor Jones made his name calling the Black Monday market crash in 1987, shorting stocks during the largest single-day percentage drop in U.S. history. Jones became a gold bull in the aftermath of the GFC and bought Bitcoin as the money printer went burr during COVID. He also founded the Robinhood Foundation in 1988 and has helped since then to raise nearly $3 billion to get New Yorkers permanently out of poverty. Paul Tudor Jones, a co-chairman and chief investment officer of Tudor Investment, joins us now on set. Paul, it's great to have you here.
It's great to be here.
Thanks so much for joining us. I want to talk, first of all, before we get into the markets, economics, and AI, about your philanthropic efforts, and specifically a partnership that Robinhood has with Bloomberg in a contest called Pick a Ticker. You have a $10,000 bet, essentially, one long, one short. How did this contest go, and who was the winner?
Well, we did it right. It actually starts right before our investor conference that we hold every fall. This year we had 40 participants. We raised about $400,000 that went, three-quarters of which went to Robinhood. It was fantastic. The winner was Bill Ackman of Pershing Square. He was long Fannie Mae. And see, number two was a guy named Mark Gallant, who actually used to work for me. And three was Stan Druckenmiller. No surprise, he's going to always be placing. They came in, I think if you took the top 3 or 4 and you had made their bets, you would have made 7 times your money in 6 months. So it's a great competition. I really hope this year we can expand it so it'll be a much bigger group. It's $10,000. It's a 6-month competition, one long, one short, and yeah, it's a lot of fun actually.
Shout out also to Anna Nikolaevsky, who got up there on the board with those.
She was our only female entrant. I hope we get a lot more ladies that'll participate this time.
So they have another chance coming up this fall.
Absolutely.
And I thought since we have you here, you could help us. Give us a tip. What's the one long you would hit for the next contest?
I would say probably the yield curve. It just depends on where I think it'll be higher at that point in time. Mine would be very esoteric, so let me think. Well, I would definitely be betting on substantially lower front-end rates. We'll have a new Fed chair within 6 months of that point in time, and I think Trump's going to pick someone who's going to be uber dovish.
Well, let's talk a little bit more about the yield curve. Matt and I were actually emailing at like 4 in the morning about the yield curve because it's broken a lot of hearts,
Right.
that steepener bet. And the way you lay it out, short end rates coming down, you have concerns about the deficit, potentially boosting the long end. It seems like a no-brainer, but it feels like it just hasn't worked. So what's different this time?
Well, it's working. It's just, it's vol adjusted. It's just a slow-moving train. But I think in the long run, it has to work. We are fiscally constrained, and we're going to have budget deficits of 6% plus as far as the eye can see. So one of the major offsets, if I was the president, would be to lower my interest rate costs by appointing a Fed chair who is as dovish as could possibly be. That's kind of the playbook when you're 100% debt to GDP and you're fiscally constrained. You can see it happening in Japan right now. Wade is reluctant to raise rates more than beyond 50 basis points, even though they have inflation. Pick a number somewhere between 2 and 3%. I think they fudge the numbers down all the time. You got wage growth at 3.5% there. So that's, historically the way that you get out of a debt trap is you run the lowest real rates possible. You lower your interest burdens, and I'm sure that's what we'll see beginning when the next Fed chair comes.
Well, we definitely want to talk about who the next Fed chair might be and who you would like to see. But let's talk first a little bit more about the deficit, because it feels like you take a look at the bond market over the past few weeks, the past few months, you can see those fears being expressed. But concerns about a higher deficit feels like one of those evergreen issues out there. So give us first your feel, how you're feeling about the deficit projections that we've been getting, and also how you might invest around that.
Well, the big beautiful bill is really interesting. It's first of all, it's a genius in branding. The name of it's a genius in branding. But I think what you got to do is you kind of you have to go to first principles. What would the actual budget look like if we were trying to balance the budget? If we were actually trying to balance the budget, what is the counterfactual to the big beautiful bill? So if you actually had to balance the budget, it probably would be the big beastly bill. And at some point down the road, who knows when that's going to be? Maybe it's next year, maybe it's the next administration, maybe it's 10 years down the road. At some point, probably, the bond markets are going to call BS on governments around the world playing chicken with them, right? So to give you an idea, if we were to balance the budget today, let's assume, first thing I would do if I was president, I'd appoint the most dovish central banker I could to lower interest costs. So let's assume that I could make a pact with my chairman of the Fed that I'm going to go through an austerity package. I'm going to balance it, but I need you to really drop rates to, let's say, 2.5%. So if you drop rates to 2.5% and you get a 50 basis point reduction, or let's say even a 100 basis point reduction in 10-year rates, that saves you $175 billion. The starting gap is $900 billion, so that saves you $175. Now I'm down to $725 billion that I've got to find through tax hikes and spending cuts. So let's assume that we're going to do this fairly. We're going to do 50% tax hikes in the rich, because they've benefited the most in the last 30, 40 years, 50% spending cuts. What does that look like? On the spending cut side, I would just to make it simple, let's just call it a blanket 6% reduction in everything. Social Security, Medicaid, defense spending, you name it. I'm just going to cut everything 6% across the board. That's what it would take to get you $360 billion, half of that $725.
Tough to do with Congress, right? You got to work.
I'm just saying there'll be a point where the markets are going to demand it. I don't know when it'll be. Maybe it'll be in my lifetime. Who knows when it'll be?
By the way, how do you invest around that? Because you famously made a lot of money shorting the yen and Japanese assets into the lost decade, which was another situation where you saw a country just boost its fiscal debt and deficits.
All right, I will get to that, but let me just finish the tax hike side.
Yeah.
So to get $363 billion in tax hikes, you're going to have to raise the top income rate to 49. You're going to have a 1% wealth tax annually, and you're going to have to raise the capital gains rate to 40. So if all we're going to do is stabilize debt to GDP, that's the big beastly bill that's somewhere down the road. And again, who knows when it's going to be. Remember, you have Italy, France, and Japan, who on the current projections will be in worse fiscal shape than we are, and they seem to be doing okay. And that's why we keep going with the kayfabe in wrestling, the suspended reality, where we like to watch the show, but we know it's not real. So we know that these 6% budget deficits are not sustainable in the long run, but it's okay because it's okay now. It's okay in the short run, and it feels good, and it's not hard. It's actually really easy. Remember, in the first Trump administration, he normalized 4% budget deficits. That's what we had pre-COVID. And now in this administration, he's normalizing 6% budget deficits. So, and I'm not judging, I'm just calling balls and strikes. That's where we are. So with that in mind, knowing that we have a whole pricing structure that's created on something that's not sustainable, it's really, really hard to invest for the long run, because the day that it'll probably be the bond market first, or maybe it's the dollar, who knows, the day that we're called to carpet on that, and the day that you actually went through that exercise that I just described, then you know that multiples on stocks will not be where they are right now.
Right.
But are you short the dollar? I mean, you mentioned you're into yield curves.
I would say that the easiest long-term trades are, the yield curve's going to steepen, probably to historic wides. You know we're going to cut short-term rates dramatically in the next year. And you know the dollar will probably be lower because of that. A lot lower because of that.
How much lower? I mean, we're off 10% from our high right now, 8%.
Yeah, I would say I think that's a year from today, that's probably a realistic assumption.
I want to go to one point that you made in that blueprint that you laid out, and that comes to appointing the most dovish Fed chair possible. Jerome Powell's term ends in May 2026.
Right.
We've heard from the president recently that he's going to announce some contenders sometime soon. Bloomberg News has reported in the past 24 hours that Scott Bessent has emerged as a pick. Kevin Warsh is under consideration. I mean, if you had your pick, who do you think is best suited for the chair?
Those are two great names. Those are two fabulous names. Again, if I was president, if I just think about President Trump, he's a growth guy, right? He's a loyalty and growth guy. You're going to be my pick if you're loyal to me. You're going to be my pick if you're a growth guy. And I'd pick a growth guy, and probably Scott would be more in line with that than Kevin would. They will have had a really close working relationship at that point. I also think, again, the playbook's pretty clear historically and right now. We are fiscally constrained. We're in a debt trap. You're going to have to run negative real rates to get out of it. That's what we did in the 50s. We had, if you'll remember, we had a variety of prices fixed by the Treasury while we had 5 and 6% inflation for a period of time. We're going to have negative real rates, and that's why you have to think about what is facing our policymakers in this debt trap as you construct your portfolio. So what would an ideal portfolio be in something like that? Well, what has worked so far? What has worked so far has been some combination of stocks, which won't do great, which would do terribly if we ever actually had, if they called us out and the bond market actually gave us an accident that then spilled over. But it would be some combination of probably gold, vol adjusted, Bitcoin, gold, stocks. That's probably your best portfolio to fight inflation. Vol adjusted, because the vol of Bitcoin is obviously 5 times that of gold, so you're gonna do it in different weights.
You said at one point you would allocate 1 or 2% of your portfolio to Bitcoin. Is it still?
Yeah, I mean, I think you just, particularly now that the roadmap is clear, then I mean, again, if I'm a policymaker, I'm going to run really low real rates. I'm going to have inflation running hot, and I'm going to tax the American consumer to get out of my debt trap. And that's exactly what Japan, who's the most fiscally constrained in the world, doing. And it works until the population throws you out because you let inflation get too hot. So maybe you're in a world with 3.5% inflation and 2.5% overnight rate, and you're kind of trying to run hot and grow your way out of it.
Well, let's talk a little bit more about equities. You know, you mentioned in that scenario that you laid out, equities obviously would do terrible, but where we stand right now, I mean, we're back to 6,000-ish on the S&P 500. We're slightly positive for the year. It feels like after the big performance that we saw in May, though, that people are not sure where to go from here. So assuming we continue along this path where inflation is under control, it seems like the labor market is under control and trade negotiations continue to progress. I mean, what's your base case on equities right now?
Well, again, so a year ago, I never thought the bond market would tolerate the big, beautiful bill. I just didn't think it would. I thought, wow. I thought there'd be a revolt. I thought bond vigilantes actually had some stuff. But
they'd come back out?
But they clearly haven't surfaced. And
we haven't seen inflation.
Well, there's a couple of things going on. One, we know 12 months from now, rates are going to drop precipitously with a new Fed chair. If you I mean, was it last week when Donald Trump saw after, was it ADP? I'd drop rates 100 basis points.
Yes,
so we know where his head is. We know who he's going to appoint.
Well, and just now, the vice president, J.D. Vance, said this is monetary malpractice in a tweet reply to our Joe Weisenthal. So they really want the Fed to cut rates.
So that also is a tailwind for the bond market, right? Because you know short rates right now aren't going to be there a year from today. So that's a tailwind. And again, I think the biggest threat to the stock market has been our fiscal profligacy, something like the big beautiful bill, because that was always going to be a threat to the safety and security of the bond market, whether investors would tolerate what's going on. And right now it seems like both globally and domestically that the world's okay with kayfabe, kicking the can down the road. We're going to suspend reality. It's okay. Mm-hmm. So, and in that scenario, again, if I have to make a decision on stocks and I think that rates are going to be 3% in 12 months, yeah, I'm probably long.
By the way, you keep mentioning kayfabe, and we're all kind of watching this knowing it's fake, but don't really care right now. Is that because we're not invested? Because Brad Gerstner has this idea, and Ted Cruz was on Bloomberg talking about it yesterday. I think it's Invest America, where you give every child born $1,000 and then allow parents or relatives to invest $5,000 a year. Then by the time they're 18 and the stock market continues to appreciate, they have a serious nut. But they've got skin in the game.
Yeah, I think it's. See, I'm the budget.
Hawk, and you,
yeah, I'm the budget
and you don't
hawk
mind spending $4 billion.
And the cranky guy, but that's the best $4 billion that would ever spend in history, because the idea of making kids stakeholders from an early age in capitalism is so important. Oh my gosh! And then allowing employers or relatives or whatever to build that account so that at an early age they understand the idea of entrepreneurship, of free markets, of self-individual excitement about understanding how productivity actually works, how we build things through our own sheer initiative. I think it's just spectacular idea. It's the best $4 billion this government could ever spend.
Mm-hmm. So there's a good way to add to the deficit, and there's a bad way. That would be the best $4 billion. I'm very conscious of the clock. We only have about 8 minutes left with you. So let's talk a little bit about AI. Mm-hmm. You've expressed concerns about AI in the past. In May, I believe you said that, I mean, it could be pretty disastrous if you think about, if you really put your thinking cap on. But I'm curious from the investment perspective, when you wear your investor hat, how do you view it then? I mean, there's plenty of things to get concerned about, but we were having a great conversation with Cliff Asness of AQR last week. He's had a real change of heart when it comes to AI. He's embraced it. Are you embracing it?
Well, for sure I'm embracing it. We tested 2 models last week internally. We have a variety of quant teams at Tudor. We tested 2 models, commercially available models. Where AI has gone in the last 4 months, is so incredible. These models do democratize quant modeling for the markets. Like, I can just think, I've been an investment in quant modeling for the last 30 years, internally, externally, a variety of ways. And what these new models do is there's a huge barrier to entry if you think about quant modeling, which is I need to have dozens. If you look at the big ones, whether it's 2 Sigma or Jump or whom, they have hundreds, thousands of employees.
That's their edge. That's Cliff's edge, right?
With these new models, wow.
They lose the edge.
It's incredible what these new models do. And the reason that I bring that up, of course you have to embrace it in our business. There's larger issues regarding AI that I think, if you don't mind, I can't tell you because I don't really trade individual stocks that much. I'm actually using the models. from a quant standpoint, so I can't tell you which companies to buy. It's pretty clear that this is obviously the most disruptive technology in the history of mankind. If I can just give you here's the way I think of AI. You're too young for this, but there was a great Twilight Zone.
Okay.
Great Twilight Zone episode where aliens came down to Earth and they had this, and they hand this book. It says "To Serve Man," and everyone goes, "Hooray! They're gonna save humanity. It's a humanitarian guide," and it turns out to be a cookbook.
I was ready to push back, but you called me out. I haven't seen that episode.
Yeah. So anyway, we just had our Robinhood AI Poverty Summit on Monday, which I was at. Oh my Lord, the things that AI are going to do for education. There is no excuse for a low-income kid not to have the greatest education if his parents or caregiver is taking care of them. My gosh, they're going to have an individual tutor to walk them through everything. So it's really spectacular. The downside of AI is that we've been served, right? When I say we've been served, you had in February Elon Musk. You can think what you think of him with regard to his moral compass, but he's the Thomas Edison of our time. Said AI has the 20% possibility of wiping out humanity. There's the safety side that should set off alarm bells throughout the world, particularly in this country, particularly with this administration. And then just last week you had Dario at Anthropic, Amadai, am I pronouncing that correctly?
Anthropic is good enough.
So anyway, he said that in 1 to 5 years, we could have 10 to 20% employment because of the displacement of white-collar jobs by AI. So now we have
10 to 20% unemployment.
In this country in 1 to 5 years. So now you have this massive stability issue. You've got a safety issue and a stability issue, and within the big, beautiful bill is a moratorium on AI regulation.
So no guardrails.
Oh my gosh. That is, when you've just been served, and no one, see the interesting is no one in the AI community pushes back on this, right? Because anyone that understands it and sees how it's progressing, these models are increasing 1 to 500% in their efficiency every 4 months. Understand, these are real possibilities. So
Paul, how do we get to guardrails? Because in the case of the debt bomb, right, as Gary Schilling would call it, you've got bond vigilantes to push back. In the case of the AI bomb, which we fear, there's no government that's going to regulate this because they'll lose out to another government.
Right. So I've come to this realization in the last 2 years that actually I think libertarianism is as much of a threat to our society as socialism. It's the other end of it, right? And you've really got this libertarian bent that's taken hold of this administration. So many of the biggest backers, but oh my gosh, our country's built on. We're built on a system of laws and regulations, not private property rights, laws against assault, robbery, etc. So what we have to figure out in a thoughtful way, which is why you have to sit down and begin a discussion. How do we have AI for good? How do we prevent the AI for bad, both on a safety standpoint and a security standpoint? One thing that we really need to do is, again, what is the government's responsibility? What are companies' responsibility? We're going to have this productivity boom, right? Capitalism is so spectacular at maximizing productivity, but it's actually really bad, and it's in the tails, I'll say. It's really bad about distributing income in a society, in a socially beneficial fashion. The best example can be, if we look at, say, since the mid-'80s, if you look and see how the productivity gains in the United States have been distributed, it's about 15% to the bottom 90 and 85% to the top 10. And so what happens when you do that? Well, you get the incredible divisiveness that we have right now. We have a crisis of trust in this country. No one knows who to trust. Hell, we had a faction of the Republican Party storm the Capitol in 2020 because they lost an election. So we're at a really socially fragile time because of wealth disparity. And now we have AI that, unless we think about how we distribute those productivity gains in a way. So is it, Dario mentioned, we're going to have a token on every time a model's used. Bill Gates said we're going to, suggested, I think 6 or 7 years ago, maybe we tax robotics. There has to be we need to sit down and thoughtfully think through how we distribute the coming productivity gains so that people are happy and not unhappy.
Paul, it's been a real pleasure having you. I appreciate you coming in, and I hope we can get you back sometime soon. Paul Tudor Jones, their co-chairman and chief investment officer of Tudor Investment, also the founder of the Robinhood Foundation. You heard the opening bell there on the New York Stock Exchange and on the NASDAQ marketplace. In terms of the indexes right now, we're seeing some slight gains. And as Katie pointed out, we're seeing a drop in bond yields and the VIX. So a low inflation number, Katie, below expectations, a lot cooler, or at least somewhat cooler than we were anticipating, has driven us higher again in risk, and we're now at 6,050.
Yeah, it's interesting to see that it was really the inflation print that is boosting markets. There wasn't too much of a reaction to President Trump posting on Truth Social that they have the outlines of a trade framework with China. But let's take a look at some individual movers right now. A minute after the bells rang, we're keeping an eye on Tesla. That's after Elon Musk said that he regrets his back and forth with President Trump last week. Tesla also delayed its rollout of Robotaxis in Texas. You can see shares rebounding a bit right now at the opening bell, Matt, up about 2.6%.
All right, we are also watching steel stocks as the U.S. and Mexico close in on a deal that would remove those 50% tariffs that President Trump announced when he was in Pennsylvania on steel imports up to a certain level. That has brought down Cleveland-Cliffs almost 7%, Nucor 5%, commercial metals down almost 2% because, of course, they would be able to raise their prices, I guess, to almost 50% if you have those tariffs. If they're only 25%, it's going to be a lot less. Let's talk about these markets. Joining us now at the desk is Alicia Levine. She is head of investment strategy and equities at BNY Wealth. And what a fascinating setup, Alicia. Great to have you here on a day when we get even cooler inflation than we had anticipated. As Paul Tudor Jones was just saying, the bond vigilantes really don't care about the debts and deficits from the big, beautiful bill. What's your take on stocks at 6,050?
Look, I think we're ending the year higher because the pain trade obviously is stocks higher.
It's only June.
It's only June. Like, it can be a rocky summer. I think the CPI this morning was surprising. But if you're looking closely, you know, the core goods are moving higher and they're no longer in deflation. So core goods are moving higher, but core services are weaker, suggesting some demand destruction in the leisure and hospitality sector as households kind of come together. Altogether, I think we're all surprised. Wall Street is obviously surprised that CPI came in lighter month over month, because last month the story was, well, the tariffs really weren't on, the data reads weren't really good enough yet. Now we have the data, and every data print is better than expected. Labor market better than expected. CPI better than expected, and everybody is off sides in positioning for where we are in the U.S. markets. And so what does that mean? That means the pain trade is higher. I can't tell you how many conversations we have. Everybody's negative, like really devastatingly so. And when everybody's on one side of the boat, the markets do the other thing.
Well, to your point on the economic data, this was the fourth straight month that you had core inflation rise less than forecast. As you said, it feels like the totality of this market is still offsides here. But the pushback to these numbers that you see in the immediate aftermath is, okay, but we're not seeing the tariff impact yet. Implying that it's coming. Alicia, is it coming?
We think it's coming. We thought we would have seen it by now. and we haven't. So I think it is coming. But then as you're getting signs that, we're going to remove the 50% tariffs on Mexico, on steel, and there's some deal going on with China, that means it's a little bit of a wait and see also on raising prices, because in the end, we have price-sensitive consumers. And the thing about the stagflationary moment that we're all afraid that we're in, and doesn't seem to be just yet, is that first you get the boost of inflation, and then you get demand destruction pretty quickly after that. It's just not happening.
Paul Tudor Jones didn't seem to buy the inflation numbers at all.
No.
Right? He said they were 2 or 3% below what the true numbers are. I wonder if his suggestion that the Trump administration is going to bring in the most dovish Fed chair possible also has some effect on this. We were reporting yesterday that Scott Bessent is in the lead, but Kevin Warsh is also a contender. What do you think about that idea, Alicia, that the Trump administration is going to be able to engineer this so that rates really are lower, even without cutting deficits?
Look, let's just go back to last September when the Fed cut 100 basis points and the 10-year moved higher. So the story here is going to be on the long end, on the 30-year, and on yields. And it's interesting because the 10-year is still sitting there in that range in the 430 to 460, despite this conversation. And if you do get a Fed chair who's going to be the most dovish to cut, it doesn't mean that the long end will be compliant with this, and I'd be shocked if it were, simply because there are too many interesting data points around inflation that that we haven't seen yet. So the story is you might engineer growth out of it, but you're certainly also going to get higher yields. And so that's the other story, of course, is that the positioning and bonds. I mean, no one is long the long bonds.
Yeah.
Right? So that's interesting as well. Like,
There's one guy, right?
One guy.
There was one guy that I sent you a message about overnight.
Yeah. Well, you sent many messages, so I can't quite remember. But it feels like when it comes to the long bond, that could be the ultimate contrarian trade to actually step in.
Absolutely.
Would you make that trade?
Not yet.
Okay.
Not yet.
What do you need to see?
Look, I think that it's uncomfortable where the big, beautiful bill is in terms of the deficits. I think the conversations have not really, in the end, if you're going to cut the debt through lower deficits, it's going to have a growth effect. And it's very hard for any administration to make that choice. What's going to happen, I think, and this is somewhat depressing on growth going forward, is that if the U.S. does nothing about entitlements, that's where the money is. It's $4 trillion. Like, why'd you rob the bank? That's where the money is.
Yeah.
That's where the growth in deficits is coming from the out-of-control entitlements. If no administration is willing to do that, it then needs tariffs as revenue, because there's not enough tax revenue. Now, I heard what Paul Tudor Jones said about taxing the high end. You can tax the high end all you want to 90%. You're still not bringing in enough revenue to deal with a $2 trillion deficit. So you have to do, you either have to revenue raise, and that's what the tariffs are doing over 10 years, over $2 trillion. Right. That's the problem here. Do we get stuck on tariff revenue because we can't cut, because nobody is willing to take the hit and have slower growth and maybe a recession? That's really the risk here.
He clearly wants tariffs to stay, and he clearly is counting on that revenue. I always remind people that taxes bring in $2.2 trillion taxing people, right? Corporate taxes only bring in like $500 billion, not even, because we don't tax corporations. I will say Gunit Dhingra, who is the New York-based head of U.S. rates at BNP, said that he sees a case for buying bonds at current levels. So there's one person out there. I got to ask quickly, Alicia, the other side of this, which is that earnings seem to be strong, right?
Yes.
And we've had a number of people, including Mike Wilson, say, hey, 13% earnings growth, everyone's ignoring this.
Right. So I'd say we are not. Yeah. We take policy as given. So we had lowered our earnings for next year in 2027, and then we immediately moved our earnings higher again for 2026. We actually see the S&P at 65 to 6,600 within the next 12 months. We have a price target close to 7,000 for next year because earnings are hanging in there. What the first quarter of earnings did is it kind of sterilized the rest of the year for this year. So we're probably coming in about 265 in earnings for 2025, but the market doesn't really care because it's looking at 2026. And so, by the summer, it's always the forward 12 months. And so earnings are coming in really well. The margins, specifically the margins that we're getting from the top tech stocks, the Magnificent Seven, the top 10 of the market, driving the margins higher for the S&P. There are pain points in retail. There are definitely pain points in some of the leisure stocks and airlines. But that's not what's driving the overall margin. And so in the end, the fear that these stocks were too high of a weight, and as they go, the market goes, it turns out they're not going anywhere because their businesses are so strong, and it is the AI revolution, and you don't short, essentially, by being underexposed, one of the greatest tech revolutions in the last 30 years. And that's what we're seeing here. So you've got to be in it.
You got to be in it to win it. Alicia, that's a nice place to leave it. Great to see you. That is BNY Wealth's Alicia Levine. I will say on the other side, so you have BNP basically betting against the steepener. Paul Tudor Jones, I wasn't expecting to get right to the yield curve steepener, but
I was hoping for a stock
trade.
pick, but he said he's not really into individual stocks.
No, he's looking at the yield curve. In any case, let's talk about some individual stocks, specifically quantum computing stocks. They're in focus at the open. That's after NVIDIA CEO Jensen Huang said the industry was at an inflection point. Huang was speaking at GTC in Paris to kick off France's Viva Tech conference.
It's very clear now that over the next several years, or at least the next generation of supercomputers, every single one of them will have a QPU assigned and QPU connected to GPUs. The QPU will do quantum computing, of course, and the GPUs would be used for pre-processing, for control, for error correction, which will be intensely computationally intensive, post-processing and such.
Now, if you're getting whiplash, that's because that's a stark difference from just in January when Huang said that quantum computing is decades away. Let's stay on those comments because for more, we're joined now by Bloomberg Tech co-host Caroline Hyde. So, Caroline, why the change of heart from Jensen Huang?
He can sell some chips. Maybe as an answer.
That helps.
It's interesting. We got to walk back on that time frame. Actually, a little bit earlier in the year when they hosted their first quantum day, they're realizing that being able to foster supercomputing using quantum is going to be a real driver of growth. You can make AI, generative AI, so much more powerful with the use of quantum computers. They're able to solve problems so much faster than the best supercomputer that's currently out there with current GPUs. And so I think at the moment he's seeing an opportunity to galvanize demand, and he's seeing breakthroughs. Look, we've just had IBM, local New York player, saying that in Poughkeepsie, just a couple of hours north of here, they're going to be building a quantum and error-correcting quantum supercomputer by 2029. So within the end of this decade, they're going to be making leaps and bounds move forward. They think it's basically just an engineering issue to make sure that you're getting this correction, the errors that are built into what are very volatile qubits that are used within quantum. They think they can solve for it. You've had breakthroughs from the Willow chip over at Alphabet. You've had Ocelot over at Amazon. And I think finally we're starting to see what he now gains as an inflection point.
Yeah, Willow, he poo-pooed Willow, right? He was like, come on, this isn't going to happen for like 15 years. Now it's going to happen like next year?
Well, I think he's seeing the desire and the money from these players, and the race is on, and they can use his infrastructure once again to be able to galvanize this growth. I think you're also seeing some of the individual stocks raise on the back of this. There are different ways to be solving the quantum computing outlook, whether or not you're using algorithm, whether you're using what's known as a gate measure and use case, which is what more IBM is stacking themselves upon. But I think that we are going to see this hope, because at the moment it is so compute intensive for generative AI. It is so energy intensive. People need to see these sorts of breakthroughs if we're going to use the sort of, well, the hopes and what Paul Tudor Jones was just telling you, this breakthrough in generative AI, and needs to compute. Maybe we could see that from quantum.
Absolutely, and we're certainly seeing quantum stocks rise today on the heels of these comments. Caroline Hyde, great rundown as always. That is Bloomberg Tech co-host Caroline Hyde. You can catch her at 11. But coming up on this program, Elon Musk has regrets. The billionaire says that he went, quote, too far about with his comments about President Trump. We'll give you the details next. This is Open Interest. Welcome back to Open Interest. It's time now for top calls. Some of the analyst action in focus this morning. And first up, J.M. Smucker actually getting upgraded to a buy over at Jefferies. The firm says that the pullback after the company's earnings release yesterday was overdone. Remember, it fell by nearly 16% yesterday, now up 1.7%. Next up, we have Urban Outfitters getting raised to a buy over at Baird after the retailer's investment day. The Baird analyst says that the reinforced a durable growth strategy. And finally, we have Stifel. It started coverage of Uber with a buy rating. The firm is bullish on Uber's advertising opportunity. You can see Uber shares pretty much unchanged, Matt Miller.
All right, let's get into Elon Musk. He is crawling back, trying to mend his relationship with President Trump, posting on X that he regrets some of the posts he made back on June 6th. And indeed, he deleted some of the key tweets. Joining us now for all things Elon Musk is Max Chafkin. Been covering the billionaire for a while, and you also host Elon Inc.
This walk back, it started almost immediately.
It's so painful.
I don't think he had any other choice. I think given where Elon Musk is, given how dependent his companies are on a good relationship with the U.S. government, and given the fact that he spent basically the last year alienating a huge chunk of his customer base by throwing his weight, political weight, entirely behind Donald Trump, I don't think he really had anywhere to go. You can't make everybody mad and still sell a lot of consumer products.
He still has $370 billion. He's the richest man in the world by over $120 billion. Like, who cares?
He's trying to go to Mars.
Stand your ground, man.
He wants to go to Mars, and that takes a lot of money. But let's talk a little bit about how dependent his companies are. I think we have a 7-day chart of Tesla, and you can really see the bite that was taken out of Tesla shares and the recovery. There it is. So it seems like, at least the market was voting and saying, we want you to make good with Donald Trump.
I mean, the market saw this walk back coming. It's funny, I believe it was on Friday, a random person on Twitter, a person with like 200 followers, said, hey, you guys should cool down. And Elon Musk said, yeah, that might be a good idea. And that was kind of the beginning of this slow walk back. You saw the deleted tweets and now this. I think he's probably going to have to go further if he really wants to be welcomed back, into the Trump fold, either by making a donation or by making, some further full-throated support for Trump. We've seen this happen with other Trump world figures. Remember that J.D. Vance said some very critical things of Donald Trump before he became Donald Trump's vice presidential pick. The price is just going to be, I think, full-throated support, probably some campaign contributions.
I'm going to take the other side. I think Elon Musk is a lot stronger than he thinks. Not only does he have so much wealth personally, Tesla is worth over $1 trillion. It doesn't matter if you sell cars, right? He only sells 2 million cars a year, so that's not a car-making valuation. And he could decommission Dragon, on which the U.S. is pretty reliant. Why doesn't he stand up?
I feel like that stock chart you just put up tells a story. I mean, so much of his net worth is tied up in a kind of meme stocky slash, faith in Elon Musk's ability to transform his ideas into actual products. The actual products, as you say, aren't quite there yet. And so this is a lot of bet on the future. How does that bet on the future change if you are kind of persona non grata with the most powerful person on earth, if you've alienated your customers? I think there are real risks here. It's true that he's in a strong position.
And he's young.
But so much of his, as he said, he's going to be around for 40 more years. But so much of his net worth is tied up in basically Tesla stock and in the stock of these privately held companies like SpaceX.
All right. Yeah, I wish that SpaceX was public because, boy, that would have been a very fun 7-day chart. Max Chafkin, a very busy man at this moment. That is Bloomberg's Max Chafkin. He covers all things Elon Musk for Bloomberg News. Meanwhile, let's take a look at some other stock movers that are on our radar today. And we start with Victoria's Secret. Profit estimates for this quarter disappointed as tariffs eat into gross margins. We've certainly heard that before, but you can see that shares actually rebounding a little bit, managing to find their way into the green. I really want to talk about Chewy because look at that, more than decimated on Chewy shares right now.
They make dog toys.
They make a lot of things. You can get all manner of pet care items from Chewy. Their profit estimates, though, they also failed to impress. Demand remains resilient. I've bought turtle food from Chewy in addition to cat litter, and they do have horse items.
Here's the thing: if you were completely destitute and had nothing left, would you still scrape together enough money to buy Catrick his meals?
Yes, absolutely.
Of course you would. Chewy's worth $17 billion. GameStop sales, and by the way, there's a relationship between the two, right? Because Ryan Cohen, who started Chewy, also, at least for a while, ran GameStop, missed sales estimates. The firm leans into collectibles, which climbed by 50% in the past year, but investors are not impressed, and the stock is down 4%.
This is Bloomberg.
The easiest long-term trades are, you know the yield curve's going to steepen, probably to historic wides. You know we're going to cut short-term rates dramatically in the next year. And you know the dollar will probably be lower because of that.
Billionaire investor Paul Tudor Jones speaking earlier to Katie and me right here on Open Interest. Pretty great conversation.
It was really interesting. Again, we marveled at the fact that he went straight to the yield curve. Wasn't necessarily expecting that. We also had a very interesting conversation about potential Fed chair picks. Remember that Jerome Powell's term ends in May 2026. And interestingly enough, we just got a Truth Social from President Donald Trump saying that CPI just out, great numbers. Fed should lower 1 full point, would pay much less interest on debt coming due. So important. You could have put money on that we were going to get a
Well, we knew J.D. Vance earlier in a tweet replying to our own Joe Weisenthal, the Odd Lots podcast, saying that this is monetary malpractice, the failure to lower rates. In terms of what we have coming up, I will tell you that the Treasury Secretary, Scott Bessent, he is set to testify before the House Ways and Means Committee, and we're going to bring you those remarks because right now, anything Scott Bessent says after he's come back from London, where he was talking with his Chinese counterparts, is very important to this market. We bring that to you next. This is Bloomberg. We are 30 minutes into the trading day and looking at some slight gains, right?
Slight, yeah.
6,044. We're 100 points away from the closing record.
Yeah, so we are close to a record high, but I still find it curious that, okay, we got positive trade vibes from the president this morning, the president of the United States. We got good news when it comes to CPI, and still, that's only good for 0.1% gain on the S&P 500. So this market seems to want a little bit more, Matt.
Where are my glasses?
Good question.
I'm looking at headlines here, but I can't read them because I don't have my glasses. No, I'm looking at Scott Bessent saying inflation shows substantial improvement due to Trump. We saw that in the CPI numbers, that rebalancing with China possible if China basically upholds its end of the deal. He credits, by the way, Trump's policies for the slowdown in price hikes. This guy gives his boss a lot of credit. He's always very careful to thank President Trump, to give President Trump all the credit, to tell President Trump how smart he is.
Well, what did Paul Tudor Jones say to us an hour ago?
Got to manage up.
That's true, and that President Trump values loyalty above all else.
Yeah, so we're going to bring you this testimony, obviously, when it happens. I should mention that I'm Matt Miller.
Oh, right. I'm Katie Greifeld.
It's an important part of the program.
Joining us
now from Capitol Hill on Bloomberg's Open Interest is our Washington correspondent, Tyler Kendall. So, Tyler, we get the gist of Scott Bessent's statement there. President Trump has done so many great things for this country already, chief among them bringing down inflation. What else do we expect him to say on Capitol Hill?
Yeah, hey, Matt. So Secretary Bessent is here in front of the House Ways and Means Committee. This was supposed to be a routine pre-scheduled hearing about the Treasury Department's budget request, except for that there is nothing routine about what is happening today. One, of course, as you had already mentioned, the White House really welcoming that CPI report with Scott Bessent giving President Trump credit there. But we're also expecting potentially for him to get some questions when it comes to filling in the gaps on what we need to know on the China trade deal. Now, President Trump, of course, said that it is a done deal subject to his final approval, as well as Chinese President Xi Jinping. But we're still waiting to fill in some of those details when it comes to whether or not China really is going to speed up those export licenses related to critical and rare earth minerals, and what sort of export controls the U.S. is willing to lift or loosen in exchange. Now, our reporting does indicate that Bessent will say rebalancing with China is possible if it upholds its end of the deal. The other thing I would quickly point you towards is that the House Ways and Means Committee, the chairman is Jason Smith. He's the lead tax writer for the House, so no doubt reconciliation is also going to come up in these conversations, because the White House really does want to get that package done as soon as possible. While it had that news on the CPI and inflation and its tariffs, the second part of this is that they want to speed up that tax policy bill as soon as possible to get more cash into consumers' pockets quickly with that front loading of those tax cuts.
All right, Tyler, thanks very much. Tyler Kendall there on Capitol Hill. And, of course, we'll bring you Treasury Secretary Bessent as soon as he starts to speak. Earlier in the last hour, we spoke with the billionaire investor Paul Tudor Jones about how he's investing for the long term.
The easiest long-term trades are, you know the yield curve is going to steepen, probably to historic wides. You know we're going to cut short-term rates dramatically in the next year. And you know the dollar will probably be lower because of that.
And joining us now, I'm pleased to say, we have Mona Mahajan. She is principal and head of investment strategy over at Edward Jones. Great to see you in person.
Thank you. Great to be here.
So let's talk a little bit about this market that we're dealing with, because I made the point just a couple minutes ago. We got positive news on trade. We got positive news when it comes to CPI. Not much of a reaction when it comes to these markets.
Yeah, it is interesting. Look, I think both of those headlines are positive for the economic backdrop. We want to see inflation contained. That's what we're getting. And keep in mind, services inflation is what surprised nicely to the downside this morning, which is good to see as well. 2/3 of the CPI basket. On the trade front, we've already started to hear the walking back of those, Liberation Day tariffs. And so I think markets had started to price in trade deals coming. Now, we got a nice framework for China potentially. We even heard from the Euro area that there is a potential for a framework on July 9th or ahead of July 9th. And so I do think we'll continue to hear these frameworks in place, details being worked out in the months ahead. Keep in mind, this is an environment where markets have already rallied about 20% in the S&P 500. We moved up pretty far, pretty fast, perhaps pricing in some of this good news. So perhaps some digestion period is normal, but we do think the backdrop is better today, and the economic outlook as we head towards the back half of the year is improving.
I wonder how optimistic you can be about 10% tariffs pretty much globally. 55% on China, right? Which is like they give us all their cheap goods and then they invest in our economy. It doesn't seem like a fantastic situation from a free market capitalist point of view.
Yeah, it's a great call out. Look, we were at 2% average tariffs in the U.S. beginning of the year. We're probably going to that 10% plus level higher in China. What I will say is broadly, analysis has shown that a 10% level is still a threshold that can be managed and absorbed. Once you get beyond that, that's where you do see movements in prices. To your point, China is now at 55%. That is a meaningful rise with Chinese trading partners. We do think that'll flow into, over time, prices moving higher and potentially economic growth softening. Now, all that being said, we don't yet see a recession as a base case in the U.S. Potential for a softening or a cooling from the 2.5% level, absolutely. But nonetheless, aside from the Chinese trading deal, we're also looking at a tax bill on the horizon and, corporations getting more clarity, which should help the earnings picture as well. We look into 2026, lower Fed rates, tax bill done, and maybe a reacceleration in earnings. So that's the backdrop we're looking at.
Well, let's talk about earnings a little bit more, because we were having the conversation yesterday that, earnings this past earnings season wasn't as bad as expected. And now you're seeing estimates move higher and higher at the index level. If you break it down sector by sector, though, it feels like a lot of that strength is coming from big tech. Are we just going back to that playbook?
Yeah, look, I think part of the story in the recovery in the markets was that big tech reaffirmed their commitment to investing in AI, investing in CapEx. That was actually a positive to hear. There was some uncertainty going into the quarter whether or not we'd still get those huge CapEx numbers, and we did. So a positive there, and that certainly drove the story in earnings, and it drove the market as well. We continue to see this AI story as a long-term secular bull theme that we need to have exposure to. So we do think growth and value parts of the market make sense in a portfolio. We continue to see that diversification trade, though, working. Will we see the outsized returns in Mag 7 that we saw over the last 2 years? Probably not to that extent, but nonetheless, we continue to see, and keep in mind, it's not only tech that'll benefit over time. We should start to see this show up in productivity gains in healthcare, financial services, industrial. So all of that we think is coming as well.
It's interesting that we had a pretty good labor number, right? Revisions maybe weren't fantastic, but we're looking for another 100,000 and change jobs to come in the next month. Then the consensus starts to drop to about half of that, 65,000 in the following couple of months. Are you worried about labor? Because for the last 2 years, everybody has been waiting for labor to break, and it just hasn't.
Yeah. You know, this is an environment where there's slow hiring, but also slow firing. So it's a relatively consistent labor market. Nothing that we feel overly bullish or optimistic about. It's slowed. It clearly has slowed over the last couple of years since the post-COVID environment. But nonetheless, a 4.2% unemployment rate. When you look historically in the U.S., the average long-term unemployment rate has been 5.5%. So we're still well below historical norms, but we could see that number creep up. We don't see it getting beyond that 4.5% level, though. So still a pretty benign labor market environment, good for the consumer.
Speaking of 4.5%, let's talk a little bit about the bond market here, because it feels like that 10-year Treasury yield, it's just glued to that 4.5% level. It moves a little bit below, a little bit above, but 4.5% seems to be the center of gravity. What does that mean for the stock market? It feels like the S&P 500 has learned to live with those kind of levels.
Yeah, it's a great point. And we also talk about that range-bound Treasury in that 4.5% range. You know, look, the Treasury market had a lot thrown at it. Moody's downgrade, mixed auction results, you know, a tax bill that showed escalating deficits, and it's still sticking around this 4.5% level.
What does it take for the bond vigilantes to get their torches and come out?
Right. And we saw 4.7, 4.8 earlier this year, but we haven't yet gotten back to that. And, you know, we come back to this notion of the TINA effect. There is no alternative in the bond space and sovereign bond space. When you look globally, U.S. Treasuries, deepest, most liquid market, well-regulated, and still offering a nice 4.5% yield for a long-term investor to lock that in now. Not a bad, relatively risk-free rate.
Well, Matt, I know you have your heart in your throat as we await these Treasury auction results, kicking off this afternoon with the 10-year.
True. Today is the 10-year. Tomorrow, the 30-year auctions. And I have been saying how interested I'm going to be in that. I'm not sure come 1 o'clock whether I'll care that much. But do you think it's going to go off without a hitch?
You know, we're hopeful that that demand picture will show up. Maybe part of the reason we're seeing a little bit of trepidation in the market as well. So let's see how the results go. But more broadly, we think
I don't see any trepidation. You know, we're at 6,050 on the S&P.
You know, I think, certainly we think there's a demand still. There's an appetite from institutions, foreign investors, and even retail investors.
By the way, if you look at it, Mona, like, okay, we're only up 2% this year, and we're used to 25% gains annually, right?
We're spoiled.
Now, we're looking at the global trade picture being completely reworked, right? I mean, Donald Trump is he said he was going to, but he's throwing everything at it. And yet, we're holding pretty strong, aren't we?
Yeah, absolutely. You know, look, obviously, when you look relative to the global stock market index, we are underperforming. European indices anywhere 15 to 20% year to date. So if he ever puts up that picture, the U.S. will be a relative underperformer thus far. Now, we also talk about how that pace of outperformance is probably not sustainable going forward. But keep in mind, global markets have benefited from lower central bank rates and more investment fiscally as well. So, but to your point, this is a market that continues to, I think, be driven by the fundamentals. A strong earnings picture, strong GDP now at 3.8%, strong economic growth picture, and a labor market that's hanging in there. Those are the three keys for a strong consumption picture in the U.S.
Well, that's a good place to leave it. Mona, great to see you as always. That is Mona Mahajan of Edward Jones. And happening right now, fresh off his trip to London, Treasury Secretary Scott Bessent is back in Washington to testify before the House Ways and Means Committee. Lawmakers are likely to ask him about trade talks with China, as well as the road ahead for the nation's economy. We'll bring you his remarks as soon as the Treasury Secretary starts speaking. This is Open Interest.
Instead, Republicans' one big beautiful bill rewards working families. Take-home pay will rise by as much as $13,300, and 7.4 million new jobs will be created or saved.
Let's get to high interest now. Look at what's making headlines around the world. Billionaire Elon Musk regrets some of his posts and comments about President Trump last week, saying they went too far. The public feud between Musk and Trump was triggered by Musk's opposition to Trump's tax bill, which posed a threat to Musk's wealth. Musk riled Trump by taking credit for his election victory, endorsing his impeachment, and even suggesting that the president was implicated in the sex crimes of Jeffrey Epstein. But Musk then later deleted that tweet. His expressions of regret, though, may not be enough to repair his relationship with Trump, who's known for carrying grudges, and maybe the Epstein tweet crossed the Rubicon, deleted or not. Almost 380 people have been arrested in the Los Angeles area since the weekend as police clash with demonstrators rallying in response to raids by immigration and customs enforcement agents. LA Mayor Karen Bass has imposed an 8 p.m. curfew. That's yesterday in a section of downtown where the tensions are running high. Meanwhile, hundreds of demonstrators marched through parts of lower Manhattan in New York City, with some participants clashing with police officers, leading to over 20 arrests. So the concern, obviously, is that these riots start to spread. And NVIDIA CEO Jensen Huang said that quantum computing is reaching an inflection point and will be powerful enough in the coming years to help solve interesting problems globally. He spoke at a conference in Paris, and Huang's forecast marks a real change in tone from January, when he said that useful quantum computers were still likely decades, Katie, decades away.
Yeah, and that whiplash, certainly good news for quantum stocks today. But earlier on this show, Matt and I spoke with billionaire investor Paul Tudor Jones and asked him about the yield curve.
We are fiscally constrained, and we're going to have budget deficits of 6% plus as far as the eye can see. So one of the major offsets, if I was the president, would be to lower my interest rate costs by appointing a Fed chair who is as dovish as could possibly be. That's kind of the playbook when you're 100% debt to GDP and you're fiscally constrained.
Joining us now is Bloomberg Markets editor Christine Aquino. And let's start with the yield curve, because the steepener has made sense for a while now, that you would see short rates drop and you would see the long end stay where it is or maybe go a bit higher. But feels like it hasn't sustainably worked, though.
Yeah, absolutely, Katie. And a lot of questions over the longevity of that trade, which has been a winner, as you pointed out. But, you know, with today's inflation data showing that inflation really is looking a lot more benign, questions over how sustainable those long-end yields can stay near 5% are really starting to bubble now. And then, of course, in the front end as well, right, we're seeing a little bit of pullback in bets for Federal Reserve interest rate cuts because, again, with inflation data looking a little softer, but also growth data holding up a little bit more. It's almost kind of like we're back to a bit of a Goldilocks environment for the economy.
Yeah, it's crazy. I mean, Mona Mahajan, who's just on with us, pointed out Atlanta Fed GDP now is at 3.8%. Now, I know that's not a forecast for the GDP number for the whole quarter, but it's pretty high, especially considering the OECD cut us to 1.6% for the year.
True.
And the inflation numbers surprise to the downside. Paul Tudor Jones said he didn't even really buy that. And a lot of people have been waiting for this number to bounce. It just hasn't. Plus, labor remains strong. Like, nobody believes that this soft landing is getting stuck.
Yeah, absolutely, Matt. And so, you know, questions over what does that mean, right, for the bond market? Again, the long end, really just people wondering, you know, how much longer can we sustain these yields close to 5%? But, you know, I think a lot of kind of questions also with regard to how the Federal Reserve is going to react to this. We're going to hear from them next week with their latest summary of economic projections. Fed's forecast still is for 2 rate cuts by December. That's looking a bit out of date. So we'll see if they have any indication of how that's going to change. But then also the future of the Fed with regards to who the next chair is going to be. We have whispers about Bessent potentially in the running for that. And markets are already front running a more dovish Fed chair moving forward.
That's exactly where I was going to go. So Alicia King was on with us earlier.
Alicia Levine.
Alicia Levine was on with us earlier. Sorry, I'm King. She's Alicia Levine. And she was saying, like, markets don't care about earnings now. They care about earnings next year. And I was thinking maybe that's the case with the Fed, right? Because obviously Powell's been resistant to cuts. But maybe this market is just saying, okay, but we're going to get this uber dovish Fed chair that Paul Tudor Jones says is going to be...
In 11 months, though. You know, you think about rates kind of staying steady
before the midterms, right?
Yeah.
Well, and markets love front running these things, right? I mean, we get these things priced well before the actual event. It's kind of like after the fact sort of activity. But yeah, so it's going to be very interesting over the next 6 months to a year.
Oh, Scott Bessent is talking right now. Let's get to the Treasury Secretary testifying before the House Ways and Means Committee.
On the president's budget, his tax priorities in the coming weeks. As part of this effort, I wish to highlight today the Treasury Department's efforts to advance President Trump's economic agenda on tax and trade. First, tax. I'm pleased to report that Treasury has just completed its most successful tax filing season in years, and we did so while improving efficiencies and cutting costs at the IRS. Critics of the president's efforts to modernize the IRS warned that the effort would result in a 10% shortfall in receipts. Instead, the opposite happened. April receipts this year were up 9.5% over the previous year, and receipts in May were up 14.7% over the previous year. Most remarkably, the president was able to achieve these results while reducing $2 billion in waste and planned IT spending at the IRS. This success has taken place against the backdrop of one of the most consequential tax proposals ever to come before Congress, the One Big Beautiful Bill Act, or as I will call it today, OBBB. The One Big Beautiful Bill will make the 2017 tax cuts permanent. This will provide individuals and businesses with certainty and build economic momentum. The legislation is squarely aimed at boosting the working and middle class and reinvigorating American manufacturing. According to the Council of Economic Advisors, the One Big Beautiful Bill will raise take-home pay between $7,800 and $13,300 for the average family of four. It will increase wages between $6,100 to $11,600 for the average worker, and it will cement no tax on tips, no tax on overtime, and tax cuts for seniors. The One Big Beautiful Bill will also incentivize unprecedented investment in U.S. manufacturing. The legislation will provide 100% expensing for new factories, as well as existing factories that expand operations and support Made in America. It will streamline burdensome permitting processes that often stand in the way of new manufacturing projects. It's time for this country to start building things again, and the OBBB makes this possible. The administration is grateful for the leadership of this committee in shepherding the One Big Beautiful Bill through the House. We are working closely with members of the Senate to get this legislation to the president's desk. Trade is the second topic I wish to highlight. The progress we have made on tax issues over the last 4 months complements the significant progress we have made in rebalancing the global economy. Since I last testified before Congress in May, the president announced a historic U.S.-UK trade deal. This arrangement, which creates a $5 billion export opportunity for American ranchers, farmers, and manufacturers, is a preview of what's to come. Dozens of countries have engaged the administration thus far with offers to improve their trade relations with the United States. This includes China. I have just returned in the middle of last night from successful negotiations in London with a Chinese delegation that will not only stabilize the economic relationship between our two economies, but make it more balanced. China has a singular opportunity to stabilize its economy by shifting away from excess production towards greater consumption. But the country needs to be a reliable partner in trade negotiations. If China will course correct by upholding It's into the initial trade agreement we outlined in Geneva, and I believe after our talks in London they will, then the rebalancing of the world's two largest economies is possible. By challenging the decades-old status quo on tax and trade, President Trump is breathing new life into the American economy. More than 500,000 private sector payroll jobs have been added since January. Most importantly, inflation in the U.S. is at its slowest pace since 2021. And the numbers we received today take us back to the slowest pace since 2020. Most importantly, we are decelerating cost increases for shelter, food, and energy. After 4 years of price increases diminishing the U.S. standard of living, inflation is showing substantial improvement due to the administration's policies. Furthermore, the labor market remains strong with low unemployment and plentiful labor demand as job openings remain high. This strength has been exemplified in the recent performance of the stock market and consumer confidence data. The President's bold leadership on these issues has laid the ground for a golden age economy. With your help, we can build on that foundation to create even more prosperity and abundance for the American people. We hope you will join us in this endeavor. Thank you all, and I look forward to your questions.
Thank you. We'll now proceed to the question and answer session. One of the more absurd attacks we hear from our Democrat colleagues is that the one big, beautiful bill is focused on the wealthy, not the working class. I'm sure the waitress who will keep more of her hard-earned money under the no tax on tips policy, or the lineman burning the midnight oil to restore power and seeing a tax cut under the no tax on overtime policy would be surprised to learn that Democrats consider them wealthy. Secretary Bessent, whether it is those policies or the tax relief in the bill for seniors, the double child tax credit and standard deduction, or the fact that the tax burden on the truly wealthy will actually rise under this bill, how does the one big, beautiful bill deliver primarily for working families?
Thank you for that question, Chairman Smith. As we saw in President Trump's first term, substantial non-inflationary growth was created. Non-inflationary growth. Real wages rose, and working Americans did better. Hourly workers did better than supervisory workers. We believe that this will happen again. As you outlined, no tax on tips, no tax on overtime, the tax breaks for seniors on Social Security, and the ability to deduct auto loans on new cars made in America, as was available when I bought my first car in 1978, will be restored. All of this will help working Americans overcome this horrendous affordability crisis that this administration inherited.
The Biden administration negotiated a global tax scheme through the Organization for Economic Cooperation and Development that would rob American taxpayers of $120 billion and would discriminate against American businesses. President Trump issued a day one executive order opposing the Biden administration's global tax surrender. In the one big beautiful bill, Congress provides the president, in line with that directive, specific targeted authorities to fight back in the event nations impose a discriminatory tax on American businesses, such as a UTPR. Last week, members of this committee met with an ambassador who was specifically concerned about how this provision would give the U.S. the ability to stand up for American businesses and respond to an unfair tax his country has imposed on American job creators. Secretary Bessent, why is it important for the Treasury Department and the President to have strong protective measures, like the one provided in the One Big Beautiful Bill, to fight against foreign taxes that discriminate against American companies? And how will the administration ensure that the use is targeted and in a manner to protect or replace U.S. tax revenue?
Mr. Chairman, for whatever reason, the previous administration chose to outsource American sovereignty on tax matters, and the Trump administration believes that is unacceptable. Unacceptable. Many other countries would seek to pull in revenues from U.S. multinational corporations into their treasuries. And rest assured that the provisions in the One Big Beautiful Bill to combat this are a staking out of our fiscal sovereignty. The U.S. tax system will stand next to what is called Pillar 2, and other countries are welcome to relinquish their fiscal and tax sovereignty to other nations. The United States will not. So this bill will allow us to prevent our corporate revenues from being drained into foreign treasuries, and that is in the hundreds of billions of dollars.
Thank you, Secretary. President Trump is also using tariffs to level the playing field and demand fair treatment for American workers, farmers, and manufacturers. Secretary, you are on the front lines of the president's economic policy agenda, including through your lead role in trade negotiations to demand fair treatment from China over the last couple days. How do the president's trade policies and tariffs and the total reset of our unfair trade and investment relationship with China that President Trump has led fit into the broader effort to reorient America's economy toward one that serves the working class instead of just the wealthy elites?
Mr. Chairman, China currently has the most imbalanced economy in the history of the world. They now have an approximate 30% share of global manufacturing, and they continually grow their manufacturing base. They are in the midst of a real estate downturn, some may cause a crisis, and they are trying to export their way out of it rather than take domestic measures such as increasing consumption, dealing with banking problems, or dealing with the real estate crisis. They cannot be allowed to export their way back to prosperity, which would mean substantial decreases in the standards of living, not only for the United States working Americans, but for working citizens across the world. Our negotiations with all countries seek to bring fairness. And I will echo President Trump's remarks. There are 18 important trading partners that we are in fulsome negotiations with. Many of them are coming to us with unimaginably good trade deals to bring down tariffs, non-tariff trade barriers, which the academic research has shown to be, can be even more pernicious than the tariffs, currency manipulation, and the subsidy of labor and industry. But as these countries come to us, and I look at the list, and I think, how could this have happened? How could this have happened? That the United States willingly became party to such unfair and unbalanced trade. And as President Trump has said, I don't blame the other countries. If you could get away with it, you should. It was those sitting behind the Resolute desk or those making trade policy who've allowed this to happen over 40 years. And we are determined to rebalance that for the American people.
Thank you, Secretary. I now recognize the ranking member for any questions he might have.
Thank you, Chairman. So maybe we could stick to a couple of facts here, as previously discussed, and that is that if you made $1 million last year, you're going to get about $84,000 in tax relief with this bill. If you made under $50,000, you are likely to get about $1 a day. The President said that we'd have 90 trade agreements in 90 days. We're 89 short because of the manner in which some of these allies have been offended. We want trade balance for sure, but we also want to make sure that it's done in a manner that will last, not subject to the whims of the administration. I understand, Mr. Secretary, that you don't agree with some of the economic forecasts that have been projected as it relates to the big, beautiful bill. So Penn Wharton says this bill will add trillions of dollars to the national debt. The Yale Budget Lab says this will add trillions of dollars to the national debt. Well, we're 0 for 2. But how about Maya McGinnis? Not exactly known for their socialist leanings. They say this will add trillions of dollars to the national debt. Well, let's go to the Tax Foundation, hardly a left-leaning political organization. They say this will add trillions of dollars to the national debt because the money's going to be borrowed. Here, facts should matter. The advice of experts should matter. We have seen the bond market's reaction to some of these proposals. They're jittery. But you know what? In this committee, we listen. The administration is putting its head in the sand on this debt issue. The facts are going to be hard to escape. So let me turn to the impact of budget reconciliation as it relates to health care. In addition to adding trillions to the U.S. debt, the bill will cause 16 million Americans to lose part or all of their health insurance, according to CBO. We know what the consequence will be of losing health insurance for the American family. More visits to the emergency room, more postponed treatments, more bankruptcies that will come because of it. The problems that people have with health insurance only mean that later on the problems pile up. Bad health, the challenge that is now going to occur for our rural hospitals, surely many of which will be forced to close. Cutting more than $1.5 trillion from Medicaid, Medicare, and the Affordable Care Act certainly will mean job losses. No industry can sustain $1.5 trillion in cuts while we borrow money for a big tax cut that, despite what has been said here today, still favors people overwhelmingly at the top. Let me say, in regard to the testimony, Mr. Secretary, that you've offered, there's another key consideration here. You're suggesting that the improvements at the IRS have all taken place in the last 6 months? It's because of what we did with the Inflation Reduction Act. That's why the improvements have taken place, the technological upgrades that have taken place as well. We have a pretty good understanding of this. We want to use artificial intelligence for better tax collections. But all of this just happened in the last 6 months. That's our understanding based upon the testimony. The Commonwealth Fund, cuts to Medicaid and SNAP are going to lead to the loss of over 1 million jobs. The American Hospital Association estimates that tens of thousands of hospital jobs will be lost as a result of these cuts. Furthermore, a professor at Yale has said that this will conservatively cause tens of thousands of unnecessary deaths. Worse health care, job losses, more borrowed money. The American people deserve considerably better than what we're being told. But let me offer this challenge, Mr. Secretary. We would be prepared on the minority side to work with the administration and direct tax relief back to people under $400,000 of joint income, as opposed to the suggestion that is being offered here today. And if you disagree with the number that I offered about tax relief for somebody who made $1 million last year, let me give you the last 30 seconds to speak to that.
The Representative Neal, I have great respect for you. We've had good conversations, but respectfully, if I weigh 1,000 pounds and you weigh 50, and I gain 10 pounds, or I gain 10%, I have gained 100,000. That during President Trump's first tax cuts, the share of taxes paid by the high end of taxpayers, they increased by more than 7%. And I'm sorry, I chuckled when you talked about the IT at the IRS. The program is 35 years behind schedule. 35 years. And is wasting $2 billion a year.
That's why we put the extra money in, Mr.
No. The extra money went in for bodies, and whistleblowers acknowledged that standards were being lowered to bring in new agents. The money is not the issue here. It is how the money is spent.
That's exactly right. We agree on that, how the money is spent. And the last point that I would make...
It has been spent poorly.
Let me make this last point, Mr. Secretary. Do you agree with the idea that in 2017, that the federal government, emanating from this committee, borrowed $2.3 trillion for that tax cut?
What I believe is that everyone on the Democratic side voted for the biggest blowout for the deficit in history, and that we are suffering from that. This past tax year, we will have between a 6.5 and 6.7% deficit, so I find it very difficult to be lectured to by people who created the largest deficit in history when we were not at war and not in a recession.
So I negotiated with Secretary Mnuchin the pandemic relief bill. If that's the reference point, that's where overwhelmingly the money went. That was not a bad infusion of money. It worked. The Economist magazine and the Financial Times said in January the American economy was the envy of the world. I yield back my time, Mr. Chairman.
Well, the spending was not the envy of the world.
I'm pleased to recognize the Vice Chairman of the committee, Mr. Buchanan.
Mr. Secretary, thank you for being here today. There's no doubt that your knowledge of finance and global markets bring a unique and welcome perspective to the Treasury, and this country is fortunate to have your leadership. Since coming to Congress, I've seen administrations from both parties, I'll say that up front, in terms of what's happened with the debt deficit. I want to get your perspective. I mean, the reality is, last 20 years, over $20 trillion in additional debt. I remember in the 80s, frankly, where we had the junk bond markets. If I look at all these younger people out here, what we're leaving them is deplorable. And I just want to make sure that we're giving as much consideration as we can to that. 49 out of 50 governors have to balance the budget. It's my biggest issue up here. It's not about one party or the other. It's both parties have done little or nothing in this area, and it needs to get addressed. When you spend last year, you take in $5 trillion, spend $7 trillion, and you average over $1 trillion a year for over the last 20 years. We need to get real about it, because again, in the 70s, in the 80s, all the junk bond, I seen what happened with all the markets and all that. So can you make, I know you touched on it, but could you, and we'll get into the pro-growth things in a minute, can you just touch on it, your thoughts about where we're at and where we're going as it relates to that? I know we've got people looking at making cuts, but I do want to get your perspective on that.
Congressman, I've enjoyed our conversations in the past. You, as a very successful private businessman, understand the power of this tax bill, especially in the expensing. You and I discussed it in great detail. And look, we do not have a revenue problem. We have a spending problem. We are right in line with the long-term revenues of approximately 17 to 18% of GDP. What we've seen here is a blowout in the spending. And as I was saying, last fiscal year was something we have never seen before. We have never seen a deficit to GDP this large when we were not at war, or not in a recession, or not in a pandemic.
Yeah,
But
Mr.
we could
Secretary,
call that a war.
We only have 5 minutes. Let me just mention just real quickly. You mentioned, and I just want to get this in, that 100% expensing is like jet fuel, and 199 is huge. These are huge opportunities to make a big difference for small business, but to me, it's because I'm so passionate about it, because they're the job creators. So can you comment on that, your thoughts in terms of 199A and 100% expensing?
Congressman, I'll very quickly comment on two things. It is the 100% expensing that is powerful, and we are adding not only expensing for equipment, as in President Trump's first term, we are adding 100% for factory structures. So if you want to build your factory here in the U.S., we want it to be tax efficient. We want you to have regulatory certainty. We want you to have quick permitting, and that is likely the single most powerful aspect. As the ranking member discussed, on the 400,000 level, that unfortunately is a disaster for small business in the 199. Most small businesses are pass-through entities, and those small businesses are substantially above that 400,000 threshold.
Yeah, let me just add just a closing point. I do want to make on the whole thing of full expensing. It's probably the most powerful tool, whether you're buying or selling. Someone that's been in business for 40 years or so, I can tell you firsthand, it's a powerful tool. It's a job-creating tool. I did want to have you comment the other thing on making, I'd say in Florida, I was chairman of the Florida Chamber, one of the big issues there is about making the tax, whatever we do on taxes, making it permanent so they got more certainty, they can do planning and investing in terms of going forward. Do you want to add anything to that?
Yes, sir. I was with a group of business leaders earlier this week, and they were telling me that they are, in fact, holding back on CapEx because they need for the tax bill to pass so that they will have certainty that the 100% expensing will come back. I think that we will see a sharp upward break in terms of CapEx as soon as we pass the One Big Beautiful Bill.
Thank you, and thanks for your leadership. We're excited you're here today.
Thank you.
Thank you, Mr. Doggett.
Thank you. If beauty is in the eye of the beholder, certainly I can understand, Mr. Secretary, why you and the members of the Trump cabinet are so enthusiastic about this beautiful bill. It gives so much to those at the top, and of course Trump appointees are not just in the top 1%, but the top 1,000th of 1%. I applaud your personal success, but isn't it true that for you and for a number of cabinet members and other Trump appointees, simply not having your taxes restored to the level that existed when President Bush and President Obama were in office at 39.6% will provide you very substantial personal benefit? Yes or no?
That is not a yes or no question, sir.
All right, if you can't answer it.
As many people
Thank you, reclaiming my time. If you can't answer,
have different tax
reclaiming my time, please, sir.
And it is shown,
Mr. Chairman, I don't want my time taken if the witness will not yield.
I would recommend, Mr. Doggett, that if you asked a question, at least allow them to answer.
You can recommend it, but you're taking my time from him answering the questions.
So
continue. Let me say, I understand you can't answer that with a yes or no. I'm concerned about the weaponization of the Internal Revenue Tax Code by the President and your role in it. Section 7217 of the Internal Revenue Code makes it unlawful for the President and his partners like you requesting IRS to conduct or terminate an audit or other investigation of a particular taxpayer. Section 6103, as you're familiar, protects taxpayer privacy. Yet in violation of both, the President began threatening Harvard in April, and on May 2nd, he declared, we're going to be taking away Harvard's tax-exempt status. It's what they deserve. And you've been part of the we when you said on May 23rd that you publicly declared that you were moving forward on this, that there were a substantial number of rules that Harvard may have violated. Can you tell me, yes or no, whether you can pledge to avoid any interference in IRS audits or investigations of particular taxpayers? And if you can't answer that yes or no, just say so, and then I'll move on to the next question.
Sir, that is without question that I will follow the law.
All right, sir. Can you tell us whether, yes or no, you can report back to this committee in 30 days after investigating to assure us that there have not been any requests by the President, any political appointee, or any family member of the President to direct or influence the audit or termination of an audit or investigation of any taxpayer or entity?
Well, Congressman, as you said, this is all private matters, so it would be out of line for me to report back on any of this. But I can assure you that I will follow the law and all proper procedures.
Thank you. I'm just asking you whether you can report back in 30 days whether there has been any attempt, I'm not asking for the specifics of who was involved, by the president or any of the other people I mentioned, to influence or direct any audit or investigation of a taxpayer. Can you do that, sir?
Well, I can report right here. I am not in the habit of repeating private conversations, but the president and I have never had a conversation on Harvard's tax status. So I will report that right here. We don't need 30 days.
I'm not asking just about Harvard. If they can pick on Harvard, they can pick on anyone. And I'm just asking for a simple report on whether there have been any efforts of that, whether from the president or one of his associates. And it would seem to me that would be easy to do. But let me move also to the question of privacy as it relates to data sharing. Do you agree that there is no authorization for the IRS to share tax data broadly with DOJ or federal agencies for the general purpose of data consolidation?
Section 6103 protects taxpayers' information. We have followed all proper procedures, and including in terms of the data sharing with the Department of Homeland Security. We are allowed to share taxpayers' information for those taxpayers who are believed to be criminals or have committed a crime.
I'm asking you about DOJ and its apparent effort to have an omnibus information sharing agreement with agencies. Do you agree that you cannot share taxpayer data without statutory authorization from this Congress, and you don't have any for that purpose?
We will follow the direction of the regulations and the court, sir.
Are you sharing any taxpayer information with DOJ for this omnibus information sharing agreement where they seem to probe into the privacy of every American, consolidating it with Social Security and other private information? Or is there such sharing going on now, sir?
Well, first of all, I would push back on that characterization.
You can do so.
And
I just want to know if you're sharing in the time
I will
that
tell
remains.
you, and there seems to be a misunderstanding among many people on your side of the aisle on what DOJ is. DOJ employees.
I understand you had some misunderstanding about it, and Mr. Musk yourself, but let me ask you again, just simply on the question I'm asking, are you sharing any of this data with DOJ without congressional authorization?
As I said, we are following all of the laws.
Thank you. I would appreciate an answer to my question, but I will yield back since my time has expired.
Mr. Smith is recognized.
Thank you, Mr. Chairman, and thank you, Mr. Secretary, for sharing your time here today. And I've not been around here as long as Mr. Neal has, but I do want to bring in a bit of a historical perspective that I think is relevant. Looking back, we can argue about CBO and JCT, and it's an imperfect system. And I think that's manifested itself in various hits and misses on projections, whether it goes all the way back to the original parts of the cost of Medicare that was way underestimated, or whether it was the structure of a more market-based approach with Medicare Modernization Act that precedes my time here, but actually cost a lot less than was projected. You go to the receipts, post-2017 tax action, the receipts exceeded what was projected. So we have an imperfect system, but it's what we have. And I think we need to go on that. Now, you take things a step further, and I remember the president's economic advisor, Mr. Hassett, pointing out that with COVID, yes, there was bipartisan action. I'll say that a few of those components still give me heartburn, as much as an emergency that we found ourselves in. But when, at the beginning of COVID, when unemployment spiked and the GDP dipped, Congress acted. By the end of 2020, GDP was back to about even. New President Biden was advised not to spend what he insisted on spending. I would suggest they're probably grappling with going back to the Obama stimulus, and they think that the only mistake of the Obama stimulus, so-called, was it didn't spend enough money. Rather than address the bureaucratic approach that, you know, like the joke was shovel ready, maybe wasn't what it was described to be. But we have these imperfect projection systems, and yet we've got the reality of experience. And I think this is important to note, and especially on the IRS structure and the desire to spend money on more people at the IRS, because that could generate more audits and that would generate more revenue, and then we can spend that revenue that, good grief, still wasn't enough to cover what the actual IRA costs came in and came to be. So we have to deal with these realities, and it's because they're imperfect systems that we just have to acknowledge. And that's why, Mr. Secretary, I had not heard the numbers on the IRS, and especially in these efforts most recently, that we were told that if we push back on the number of new IRS agents and auditors, we were going to undermine the revenues, and yet a different approach that focused more on technology, because there was a willingness to focus more on technology here on this side of the dais than there was with just hiring more people that actually, even in the best of scenarios, did not come to be. Thank goodness, I might add. But we are in a situation now where in 2017, we did what was right, and I'm glad that there was bipartisan support to extend a lot of what we did in 2017 that did not have bipartisan support then. Now, that didn't pass the Senate. We are where we are, and now heading into a situation where what we have at hand with this reconciliation bill is good for workers. It's good for workers. It's good for economic expansion and encouraging investment and increasing productivity so that we can grow the economy without triggering inflation. President Biden was warned not to push more spending by Democrats, I might add. I think of Mr. Summers primarily, advising against that. Did it anyway. We are still paying the price. We're trying to dig out from a lot of that. And that's why we're doing the bill that we are. Gosh, I have other things that I'd love to ask questions on. But I think it's important to realize that we need to deal with reality here. That's what we are doing. And Mr. Secretary, thank you. I look forward to further conversations, whether it's trade, whether it's IRS, whether it's various things that we need to do to get our country to a better place, realizing that the solutions are really in the private sector and triggering everything we can on our side to encourage the private sector to provide more opportunity. Thank you. I yield back.
Thank you, Mr. Thompson.
Thank you, Mr. Chairman. Mr. Secretary, thank you for being here. You know, the economic outlook of the United States has soured a bit since President Trump assumed office. We've gone from record lows in unemployment, historic growth, and lowering inflation.